Welcome back, everyone, to The Deep Dive. Today, we're really digging into something interesting happening in Thailand. They've made some pretty sweeping changes to their tax landscape. It's quite the pivot. And it affects, well, two really different groups, Thais coming back home and also foreign residents, business travelers too.
That's exactly right. It's this dual policy thing they're doing. We've seen some sources detailing these new incentives, trying to reverse that brain drain phenomenon. But at the same time, there's this major reinterpretation of tax rules that's hitting expats.
Yeah, it's quite the combination.
Mm.
So our mission today really is to unpack these two different moves. We want to clarify who's affected, what the deadlines are, what's actually changing, like this whole tax residency definition thing, stuff that professionals and, long-term residents absolutely need to get their heads around. Like now.
Exactly. We can kind of break it down into two main areas for this deep dive. First, there's this fixed 17% tax rate, very attractive, aimed at skilled Thais returning. That's the pull factor. And then pillar two is the, let's call it the tightening for expats. Basically, any overseas income you bring into Thailand is now potentially taxable, doesn't matter when you earned it.
Okay, a real carrot and stick approach then. Let's start with this brain gain strategy.
Yeah.
What's the thinking here? Why pour resources into getting skilled Thais back right now? Is it just about filling jobs?
Well, it seems to be more than just filling immediate spots. It looks like a longer-term play, a strategic thing. Thailand knows a lot of its top talent, engineers, scientists, tech people. They've been working abroad for years. So this is a direct shot at reversing that brain drain. They want that expertise back home to boost innovation, productivity, that kind of thing.
And the big lure is this flat 17% income tax rate. That sounds significantly lower than usual.
Oh, it's huge. Precisely. Normally, Thailand has a progressive system, right? It can go up to 35%. So offering a flat 17%, well, that's a massive saving for high earners. It's a very clear signal. We want you back, and we value your skills.
Okay, but surely there are strings attached. It can't be for everyone. What's the checklist? Who actually qualifies?
Right. It's pretty specific, quite targeted. You have to be a Thai national, obviously. You need at least a bachelor's degree. And, crucially, you need proof of at least 2 years working internationally. Oh, and you can't have been working in Thailand during that tax year. It's really for those coming back from overseas work.
Interesting. Does that create any friction, maybe, with skilled Thais who stayed home and are paying potentially much higher taxes on similar work?
That's always a potential issue, isn't it, when you target incentives like this? I think the government's angle or hope is that bringing this top-tier talent back will lift the whole economy, foster innovation, create new jobs downstream, strengthen key industries like tech, advanced manufacturing, R&D, so everyone benefits eventually. That's the narrative, anyway.
And it's not just the individuals getting the break, right? The companies hiring them get something too.
Exactly, and that's a really powerful part of the strategy. Companies that hire these qualified returning Thaises, they can get a 50% tax exemption on the salary costs for those specific employees. That makes hiring these returnees incredibly attractive financially for businesses in those target sectors.
50%. Wow. And this isn't just a pilot program. They're committed to this for a while.
Yeah, seems like it. The program's set to run until December 31st, 2029. So that suggests it's not just a quick fix they're looking for. It's about building a sustained capacity over the next few years, using tax policy as a steering mechanism, really.
Okay, that's a really strong pull factor. But like you said, there's another side to this policy coin. The changes for expats already there seem less welcoming. Let's shift gears to that.
Right. This is where things get, well, complicated and potentially costly for long-term foreign residents. Starting January 1st, 2024, the way Thailand taxes overseas income brought into the country has fundamentally changed. It's based on a reinterpretation by the Thai Revenue Department.
Okay, so for expats who've been there years, maybe relying on the old system, what did that allow them to do? Can you remind us?
Yeah, the old rule was honestly a big planning advantage. Foreign income you earned was only taxed if you brought it into Thailand in the same year you earned it. So money earned in, say, 2022, if you transferred it in 2023 or later, it wasn't taxed, gave people a lot of flexibility.
Right, I remember that. So the new rule, what's the absolute key difference people need to grasp?
The timing loophole is gone completely. Now, any assessable income you transfer into Thailand is subject to tax, regardless of when you actually earned it. Doesn't matter if it was last year or 10 years ago. If you bring it in now, it counts as income for this tax year.
Whoa. Okay, that's massive. So let me get this straight. If I earned, say, $50,000 working overseas back in 2020, and I transfer that money to my Thai bank account now, in 2024, that $50K becomes taxable income in Thailand for 2024.
That's the current interpretation, yes. That's how it's being applied.
Yeah.
It basically shifts the focus from when you transferred it to what you're transferring. If it's assessable income, whenever it was earned, bringing it in now triggers the potential tax liability.
Okay, that sounds like an administrative nightmare, though. How do they even track that? How do they know if money coming in is from 2018 earnings versus, savings you had before this all started?
Well, that's the million-dollar question, isn't it? And it highlights why record keeping is suddenly critical. The burden of proof is now squarely on the taxpayer. There is one crucial exemption: savings. Money you already had saved up in foreign accounts before December 31st, 2023. That amount, if you can prove it, remains exempt when transferred. But you need proof, like rock-solid proof. Bank statements showing those funds existed before the cutoff.
Got it. So meticulous records are key. And this isn't just about the source of income, is it? There's also a change in how they define who is actually liable for Thai tax, the residency rules.
Correct. And this is super important for anyone spending significant time in Thailand, maybe on long business trips, using service departments, that sort of thing. Your tax liability, specifically for this foreign income rule, is now tied directly to how long you physically stay in Thailand. It's not about your visa type anymore.
Okay, so what's the magic number? How long do you have to be there?
The threshold is 180 days. If you, as an expat, are physically present in Thailand for 180 days or more within a single calendar year, boom, you're considered a tax resident for that year. And that means this new rule about taxed and transferred foreign income applies to you. That 180-day clock starts ticking from day one.
Right, so anyone on an extended work assignment or maybe retirees splitting their time needs to track their days really carefully now.
Absolutely. It forces a much more rigorous approach to managing your physical presence if you want to avoid becoming a tax resident unintentionally.
But just to be crystal clear, income someone earns inside Thailand, like from a local job or renting out a condo they own there, that was always taxed, right?
Yeah.
Regardless of days spent.
Oh, yeah, absolutely. That hasn't changed. Income from Thai sources, salary from a Thai company, rent from Thai property that always been taxable in Thailand no matter how long you stay. This new reinterpretation specifically targets that foreign earned income being brought into the country by tax residents.
Okay. Taking a step back, this kind of feels like part of a bigger picture, doesn't it? We see governments globally trying to tighten things up, increase revenue. Is Thailand just joining that trend?
It certainly looks that way. Yeah, it aligns with this global push for greater tax transparency and making sure everyone pays their share, especially higher net worth individuals or long-term residents. Thailand's always had this huge appeal, great lifestyle, relatively affordable. That's drawn in so many expats and retirees. But this change definitely shifts the financial calculation for staying long-term.
It really changes the math, especially if most of your income comes from outside Thailand. Which sectors do you think will feel the pinch from this most directly?
Well, you'd expect industries that rely heavily on that long-term expat market. Think about high-end real estate, maybe luxury retirement communities. Also, potentially the hospitality sector offering those long-stay packages. Even international schools, perhaps, if families start reconsidering long-term commitments due to the overall cost increase.
So even if the lifestyle is still great, the added tax burden might push some people to look elsewhere, maybe other places in the region.
That's the big question now, isn't it? We're likely seeing, or will see, long-term residents and maybe retirees reevaluating things. If the total cost factoring in this tax makes Thailand less competitive compared to, say, Malaysia or the Philippines or somewhere else with maybe more lenient rules on foreign income, well, people might vote with their feet.
Okay, so bringing it down to the individual listening, maybe you're an expat there, maybe you travel there often, getting close to that 180 days. What's the immediate practical advice? What do you need to do?
Number one, without a doubt, get your financial records in order, meticulously. You need to be able to prove when and where your income was earned. And crucially, like we said, if you want to claim the savings exemption, you need those bank statements proving funds existed before December 31st, 2023. Don't assume anything is untraceable.
Right. Assume they can ask for proof. And given the complexity, especially around proving historical savings versus recent income, what's the single most important step someone should take now?
Get professional advice. Seriously. And specifically, get local professional advice. You need a qualified Thai accountant or tax lawyer who understands these specific new interpretations and how the revenue department is actually applying them. This isn't something to navigate with generic international tax advice. You need someone on the ground in Thailand who deals with this daily.
That seems like very solid advice. So to wrap up our deep dive today, Thailand's made this really bold two-pronged move. On one hand, rolling out the red carpet with that 17% tax rate to pull skilled Thais back home, a real talent magnet. And on the other hand, significantly tightening the rules for foreign residents, making all transferred overseas income potentially taxable based on residency duration.
Exactly. It sets up this fascinating dynamic in the region, doesn't it? Thailand is clearly prioritizing attracting specific types of human capital, perhaps even over maximizing revenue from the general long-term expat population. Which leaves us with a really interesting final thought. How will Thailand's neighbors react? Will countries like Malaysia, Vietnam, or others try to copy this dual approach, attract specific talent while also tightening rules? Or will they see an opportunity here? Maybe keep their tax rules for expats more lenient to attract those who might now be looking to leave Thailand because of these changes. Watching that competitive response unfold across Southeast Asia, that's going to be really telling over the next few years.
A very provocative question indeed, a potential ripple effect across the entire region to keep an eye on. Well, that brings us to the end of this deep dive. Thanks so much for joining us.